I'm here with James Lavish from the Bitcoin Opportunity Fund. We're here at Bitcoin Atlantis. So, James, let's get started. I know you're also the author of The Informationist, a great newsletter. So, guys, check that out. So, James, let's kind of get a bit of your take on where things are with U.S. government debt. We've spoken a bit about this. I know it's one of our the hobby horse issues for you and just in general. So, let's just talk a little bit about that issue. I mean, it looks like the government debt has gone from 33 trillion to 34 trillion in the blink of an eye.
In a nanosecond. So, yeah, I mean, the problem is, Stefan, is that we are now adding just about $100 trillion of debt to the overall government debt every 100 days.
So 100 billion.
100 billion every day.
Yeah.
Sorry, the numbers are so big.
Yeah.
I've spoken too many times today.
Yeah.
So $100 billion every 100 days. So if you think about it, the U.S. collects about $4.9 trillion in taxes annually, and we're carrying over $34 trillion of debt. And so now we're adding another 100 billion every 100 days. So this is like an individual, like a person who is making $100,000 a year, is carrying $5 million of debt, and is adding $140,000 of that every 90 days, every 3 months. It's just mental.
And no bank would give you that kind of credit if you were an individual, right?
No line of credit for that. That's right. So, that's the issue, and it's unsustainable. Everybody knows it, and even Jerome Powell admitted to it on 60 Minutes just a few weeks ago when asked, like, what about the debt? Are you worried about the debt? And he admitted, he said, look, I don't work for the Treasury. I can't tell. I mean, I work for the Treasury. I work for the government. I can't tell them what to do. And he said, but it is unsustainable. Yeah. It's unsustainable.
So obviously this is bringing up the whole question like dollar milkshake theory and what comes next and multipolar world and all these kind of ideas. I think there's two different ways you could argue, right? Like you could go like Brent Johnson, Santiago Capital will say, look, the dollar is the least dirty shirt in the in the laundry. But another view would just be like, look, it's going to go multipolar, and maybe there'll just be less people buying U.S. government bonds altogether, and they'll just choose other assets. Now, of course, we would love them to choose Bitcoin, but maybe businesses will just hold less U.S. government debt, and instead they might hold physical property or some other country's bonds or something else. I'm curious where do you stand on this?
Well, look, I mean, it's no secret, again, that the government needs to issue a ton of debt. Because we operate in a perpetual deficit, we have to issue more debt to cover the old debt. So as debt matures, we have to issue new debt to pay that off. So everybody knows this, and we're borrowing more than we're making. So we have to issue more debt every year, another $2 to $3 trillion every year. And so it's no secret that there will be a massive wave, and eventually a tsunami of debt that comes at us. So if you're an investor and you hold long-term debt, your issue is that it's not just that there's irregular inflation. It's that we will hit periods, and like Luke Roman talks about this, and I think Lynn Alden talks about this, but I expect us to hit periods of high inflation. We already have structural inflation, but we may get super high inflation for 2, 3, 4 years, and we're talking about 12, 15, 18, 20%. Not the 2 to 3 to 5% that they admit to, but real inflation that reaches these levels. So if you're a business and you've got cash on your balance sheet, and you're all excited because you're making 4 or 5% in a money market or in T-bills for a little while, that's all great. But when the real inflation rate jumps to 12, 15, 20%, that's a loss of 7, 10, 15% of purchasing power for you every year. And so what do you want to do? You want to hold an asset that stores that value. And that clear asset for us, at least, is Bitcoin, and it's a clear store of value for long periods of time.
Yeah. So I think a really interesting point I've seen recently is Matthew Mazinskis has been speaking about this idea of base money, right? And he spoke about recently how Bitcoin had just hit 7th in the base money sort of, if you count just on base money, like central bank money or central bank reserves, and I believe even recently might have just pipped the UK as well, so it would now be 6th counting gold. So gold at the top, and then the others, and then Bitcoin is already up there. So I'm curious how that plays in, this concept of base money as contrasted with other ways of counting inflation. And let me just put the point this way. So the way I've seen him point it out is since 1969, the US base money has expanded at about 9% per year. And since 2008, that number is actually closer to 11% per year. So obviously, as you were just saying, if you're a stock investor, if you're a bond investor, and you are not making more than 11%, you're losing money, aren't you?
That's right. So, and if you go back to, I believe 1971, it started about 7% per. It's about 7% per year. So it's clearly been going up, right? So, yeah, that's your challenge. Your challenge is how do you keep up with that base that inflation? The base money is it's being devalued, and so it's being debased, literally. And why are they doing that? They're doing that so they can pay back those bonds with cheaper dollars, with cheaper pound. And we saw it. So go back to the UK last year, 1 year ago this fall, when they ran into the gilt crisis. Well, what was going on there? The problem is there's so much debt in the system that and we had been running at 0% interest rates for so long that the pension funds in the UK knew that they had these liabilities that were forward liabilities that they have to cover. So when pensioners retire, they have to pay out a certain amount to them, and they know they've got to pay out that amount. Well, how do they keep up with that inflation when you have zero interest rates? What they were doing is they were levering. They were putting leverage on the safest trade that they could, which is the gilt in the country. They would leverage those trades 2 to 1, 3 to 1, and then when the interest rates moved, it blew them up, and they went insolvent. They literally were going insolvent until the UK stepped in, the Bank of England stepped in and rescued them.
Yeah. So on that topic, let's talk a little bit about some of these various programs, right? And I know you detail some of these on your newsletter, things like BTFP and so on. Some of these are programs that I think, to quote Lynn Alden, they sort of loosen for the government, but they tighten for the everyday private sector. So I'm curious your view. Are they just going to keep coming out with new programs, or they just keep extending these programs, or what do you see as likely possibilities there?
Super likely, almost a certainty that they have to. And so the Treasury needs to keep people, they need to keep companies and banks solvent. They need to have enough liquidity in the system to buy these treasuries. There's no choice. They must. So they come up with the BTFP program so they have enough liquidity to keep going. What's going to happen next? Well, you've got the reverse repo market, which started with over $2 trillion, $2.5 trillion of capital in it, of money. And now it's been drawn all the way down to somewhere between $500 and $600 billion. So that's all that's left. What's happening is that is buying all those short-term T-bills, because the money markets are in the reverse repo and they can buy T-bills instead, so at a little bit better rate. But that's about to expire, meaning it's about to be dried up. Once that's dried up, then the Treasury has to turn to longer dated treasuries to start to take money out of the bank reserves, because they can hold treasuries. But once those bank reserves get down to 2.5 trillion, then it becomes a big red flag for the Fed and the Treasury that they've got to have new programs to make sure that they shore up the liquidity, because you can't have a Treasury auction fail. You must keep them liquid. And so what they do is that the first thing they're going to do is, when the reverse repo market is dried up, when the BTFP program, when that matures, expires, What they've been doing is they've been talking about this new rule that's going to force banks to use the overnight window, the discount window. And traditionally, Stefan, that had a negative connotation to it. If you used that window as a bank, it meant that you were illiquid and that you were running into problems. It would be like an individual using a super high rate credit card because they had no other choice. But they're making it a requirement for every single bank who wants to have access to that capital to use it at least once every year. So what are they doing? They're taking that negative stigma off it. They're opening that up and making it a part of normal practice, which is there's nothing normal about it to have to borrow money from the government.
Yeah. So definitely something to keep an eye on. Let's turn a little bit to the Bitcoin world in terms of Bitcoin industry, Bitcoin companies. Is there any interesting trends you're seeing from that perspective? Things that you want to highlight there?
As we see Bitcoin, the ETFs take hold, and we're seeing about $500 million come into those ETFs every single day. It's just reinforcing this growth of Bitcoin, and what's happening is it's forcing institutional investors to do the work and to understand Bitcoin, because you can't be an institution and not own any while your competitor does. It's a simple, extremely simple analysis just to look at whether you own Bitcoin in your portfolio versus a 60-40 portfolio. And if you own just 3%, it magnifies your returns to a level that you just can't ignore. So it's forcing them to do the work. It's forcing them to understand it. What is that going to do for us here? Well, we're very U.S.-centric. Obviously, United States investors, they think of Bitcoin as a store of value primarily. And so, but as they learn about this as a store of value, they go down that rabbit hole, as you and I have done, and they see what the use case is for it around the world. When you have 1.5 billion people in the world who are unbanked, they recognize the fact that this decentralized protocol that can be on anybody's phone, and Bitcoin can actually be used as money, then that's where the new investment comes. And these companies that are making all the Lightning companies and the wallet companies and the software companies on individuals' phones, like these are big deals. And what we're seeing is that interest to inject capital into those projects, into that infrastructure, and to build the ecosystem. And that's exactly what we're doing over at our fund.
Great. Okay, well, let's leave it there. Listeners will put James's links in the description. Check out The Informationist and the Bitcoin Opportunity Fund. Thank you, James.
Thank you so much, Stefan. See you next time.